Okay, I believe we are ready to begin. I'd like to welcome everyone to today's webcast, which will explain how property assessed clean energy, also known as PACE financing, can help eliminate the financial hurdles that often prevent energy efficiency upgrade projects from launching or moving forward. And out of respect for your time, we're going to get things started right away. But before I introduce your speaker, I'd like to go over two important items with you. First of all, you're going to be able to download several documents towards the end of the webcast. Just be sure to click on the download buttons during the webcast. When the webcast ends, you'll be able to print those documents or use them in any way you want, but only if you've clicked the download button during the webcast. And secondly, I would encourage you to submit any questions during the presentation using the question box in the lower right-hand corner of your control panel. While our speaker will attempt to answer questions during the presentation, if there's too many, I will either attempt to answer them immediately for you via email, or we'll answer them after the presentation ends. So at this point, I want to introduce our speaker, Scott Ringline. He's going to be sharing some information with you that is geared primarily towards facility managers. Now, Scott is one of the foremost authorities on property assessed clean energy, or PACE financing, and he's frequently asked to present PACE workshops for groups or at events throughout the United States, such as National Automotive Dealership Association, the Michigan Association of Certified Public Accountants, at Manufacturing in America, and he was recently featured on a segment of the show, The Emerald Planet. Scott will be discussing how PACE is a unique solution for facility managers who are often frustrated when their proposed projects get canceled because they can't overcome corporate payback hurdles, or because upgrades or needed improvements don't meet the arbitrary targets set for return on investment. Scott Ringline is the president and CEO of the Energy Alliance Group of North America. So Scott, if you're ready, we're ready to begin.
Hey, Kerry. Thanks for that awesome introduction. I surely appreciate it. I want to welcome everyone to today's webcast entitled Eliminate Financial Hurdles with Property Assessed Clean Energy Financing. Also want to thank everyone for taking time out of their days to attend. So a couple of housekeeping issues before we get started. First of all, as Kerry mentioned, you will be able to download a couple of resources towards the end of today's program. We encourage you to do so. And make sure that you download them before the webcast ends because you will not have access to them afterwards. Also, throughout today's program, you'll be able to submit questions. And towards the end of the program, we will answer some of these questions. But of course, we won't be able to answer everyone's. But we will have a staff member answer them after the webcast. So don't resist to do so. We encourage you to actually ask as many as possible. So what are we going to talk about today? Well, I'm not sure if you have noticed, but we have some real inefficient buildings in the U.S. And one of the primary reasons for that is that building owners, facility managers, property managers, ops managers have some large hurdles to get over to get access to capital to make these energy efficient improvements. So today we're going to talk about a new program that's out there that can help overcome these hurdles. And the name of the program is PACE, PACE Financing. And PACE is an acronym for Property Assessed Clean Energy. And this is truly a paradigm shift in how energy efficient projects are funded. The program was established for energy efficiency improvements to buildings, and it can be used for energy efficient improvements, water conservation improvement projects, and of course renewable energy projects. So why PACE? Why are we talking about PACE today? Well, we got a big problem out there. We have close to 6 million buildings that are over 50 years old. 30% of the $200 billion that we spend annually on energy is wasted by inefficient technology. And two of these technologies, which uses a majority of energy at our buildings, lighting and HVAC systems, 80% were installed before 1986. So we have an aging building, we have aging technology, and we have very inefficient technology. And truly, there's not being much done to address it on a very, very wide and far-reaching scale. Now, this is not something that we're noticing, but industry's noticing. There was an article in Forbes magazine that talked about our aging buildings, that 50% of the commercial buildings were built before 1980, and that one of the single most important things that the industry can do to reduce our energy footprint would be to retrofit these buildings with energy efficient technology. And it sounds good, it sounds easy, but the issue has been access to capital to make it happen. So what's different about PACE? Well, as I spoke about early on, we talked about the barriers or these hurdles that everyone has to go through to implement energy efficient improvements in their buildings. And some of them are lack of capital, just cannot get access to the capital needed for the project, unbelievable ROI targets, very, very short payback periods, and limited terms of the funding options that are out there today. So even if you can get access to the capital, typically either ROI or the payback is affected by the term you can get the funding for. So funding terms of 5 to 10 years for very, very large capital improvements with some energy efficiency improvement are just not a good investment based on the ROI targets and the payback hurdles that are being used today out in industry. So what's different about PACE? Well, probably one of the most important aspects of PACE is access to long-term capital. And we're talking about 20, 25, 30 years for doing energy efficiency improvements. And what that does, it is allows the building owner to then leverage these savings, energy, maintenance, and also end-of-life replacement savings to pay for the cost of the PACE financing over the term. So cash flow positive from day one, cash flow positive throughout the entire term. In this money that we're talking about, businesses are paying it today. They're just paying it to the utility companies. Basically, what PACE does, it takes a portion of what you're paying today and it utilizes to pay for the upgrades, but also because it's cash flow positive typically from day one, you're also improving the company's bottom line. So you're putting money back into the company for other uses. And we'll talk more about that as we go through the webcast today. So what is PACE? Well, PACE is funded through the same mechanism that is used to fund large property improvement projects such as roadways, sidewalks, water system improvements, sewer system improvements in local communities. So if you're a building owner and you're on a street or a roadway that the local community is going to install new sewer systems, it is paid for through a special assessment that's placed on every property that's affected by this improvement, and it's paid for over a very long period of time, 15, 20, 25, 30 years. And it's a fixed payment. It shows up on your tax bill. And as the building owner, you're responsible for paying that assessment. It's an expense, it's not a debt. And if you sell the building, the next owner is responsible for continuing the payment. So that principal is not paid off. The principal transfers with the property upon sale. And if by chance there's a foreclosure on the property and it's retained by the local community, if somebody wants to purchase it, what are they responsible for? The back payments. Not the principal itself, but the back payments, similar to typical property taxes. So for PACE projects, the funding is secured by the property and the building, and it's accessed through this special assessment mechanism. So that's how the capital is secured, and then that's how the capital is paid for. It's paid for through the property tax mechanism. PACE itself has to be approved at the state level. This is not a federal program. This is a state-based program. Every state is going to vary, of course. And then once it's adopted by the state, it has to be adopted at the local taxing authority. The state does not collect property taxes. Typically a county, a city, or a township are the tax collectors. And that's who would adopt this program and allow it to be used by the local building and property owners. The funding itself typically comes from private entities. So this is not funded by taxpayer dollars. The only taxpayer side of it is the entity that's collecting it and actually, putting the assessment on record. The money itself comes from typically four sources. The first one is private equity funds. So these are large private equity funds that are investing in 401ks, pensions, annuities. And they're looking for, large, long-term, fixed-rate returns. So large projects, long-term, 25, 30 years, and fixed rate. So it's a fixed interest rate. Another funding option is bonds, where you can actually go out and sell a bond to raise capital for these energy efficiency projects. And that is also a quite popular mechanism because it's traditionally been used for what? These other improvements, that have been used in the past for special assessments. Also, some states allow for self-funding, meaning you as the building owner or possibly just an investor can fund the PACE projects. You establish the interest rate that you would pay yourself back through, so whether that's 5 or 8%, as long as the project is cash flow positive. So you can't necessarily charge a 20% interest on your money if there's no rate of return. So typically what we see is interest rates would be established, like I said, anywhere from 5 to 8 or 10%, as long as it's financially feasible. And then lastly is another funding source is traditional funding. So banks. Some banks are involved. However, they lack the appetite for this type of risk, or at least their underwriters lack that appetite. So typically with traditional funders, their terms are shorter, probably about 10 years, and then the amount that you would have access to is smaller. but it is an option and it's something worth mentioning. And then finally, outside of just the funding mechanism for these projects, it's also a tool that can be used by local communities for economic development. One of the things that communities have today are a lot of buildings that are not generating tax revenue, and they've run out of tools. They don't have any more tax abatements to give away, and they're trying to get people to come in, buy these buildings, and put them to use and pay tax because they need that revenue source. So with PACE, if they become a PACE district and allow building and property owners to use this mechanism to fund these projects, then you can encourage first those that own the building and properties in the local community. They can use this tool to improve their buildings and hopefully stick around rather than moving, but also encourage others to come to the community, purchase these buildings that are not generating any tax revenue right now, use PACE to upgrade the facility so they're not taking capital out of their own pocket to do it, and then it's not the company itself is not incurring debt to do so because tax is treated as an expense. So it's kind of a win-win for everybody. Communities can use it to get people to come in, purchase these buildings, upgrade the buildings, and then generate a tax revenue because now they're actually paying property taxes in addition to the special assessment. But also it gives the building owners in those communities the same benefit. So where's PACE? Well, it originated in California around 2009. It actually started in the residential side of things and then quickly morphed into the industrial commercial side of the business. It's been adopted in 32 U.S. states and Washington, D.C., and it's actually expanded outside the U.S. Over the last couple of years. Australia has adopted it. However, I really don't have any information to share with you in regards to how well it's working there, but we do know that they have adopted it, and we get a lot of inquiries from people outside of the U.S. that are very interested in the program and the mechanism and how it would work, so we expect it to continue to expand into other countries. So what properties qualify? Well, it varies by state. Like I said, this is not a federal program. This is a state program, so each state is going to have a little different twist on the rules. It is allowed to be used on single-family homes, so residential in some states, but this has not been adopted broadly yet. We do know that California allows it, Ohio allows it. I'm sure there are some other states. We're based in Michigan, and to date, Michigan does not allow it for single-family homes. So the main focus is the commercial, industrial, nonprofit, and multifamily buildings, and we see this basically in all states kind of across the board, that's the primary focus of the program. However, government-owned buildings do not qualify in a majority of the states. Why? They're not a taxable entity. And the only state that we're aware of that does allow it is Ohio, and that's because the funding actually comes through the public bond fund, which is already used for government buildings. So they're able to use that and leverage that through the PACE mechanism because they're accessing public money already. But here in Michigan, it cannot be used unless the building is actually leased versus owned. And we'll talk about that more towards the end of today's program. But again, Government-owned buildings typically do not qualify unless they're leased, meaning, the government doesn't own it, it's owned by a private entity, and the private entity is using PACE to upgrade it. The government entity is just benefiting from the upgrade. So the property itself has to be in a PACE district. We talked about that it's adopted at a local level, and then the property owners can actually use it. If you have a property in a state that's PACE approved, but it hasn't been adopted locally, it's kind of a grassroots effort to get it approved. Typically what works for us is to utilize that property owner and go in and meet with the local authorities to talk about adopting it, because the building owner is the constituent and they are the ones that would benefit, and that's who should be promoting it locally. Also, property owner needs to be current on their property taxes. Remember, this is a property tax. It's a special assessment property tax, so they want to make sure that you're already paying your taxes. If you don't pay your taxes today, they're not going to be interested in funding a program to have you do so on future taxes. Also, and this is a big important thing, is the property cannot be leveraged. So what does that mean? Well, with PACE, typically the max loan to value, including the PACE amount, is 80%. There are some lenders that will go out to 95%, but pretty much across the industry, 80% seems to be the norm. And this would include whether you have a mortgage on the property, whether the property has been used as collateral to, possibly purchase other property, or there's some contingencies against the property. So there will be title searches done to ensure that it is either free and clear, or there's a complete understanding of what is against the property from a leverage standpoint. Also, the business needs to be healthy. These investors are not going to invest in the property if the business is not going to be there for very long, because then they're waiting to be paid. So what projects qualify? Well, the main purpose of PACE is for energy efficiency, renewable energy, and water conservation projects to pay for them. And it can be used either on retrofitting existing buildings, or it can be used for new construction. So whether you're upgrading an existing building or building a new building, PACE financing can be accessed for these energy efficiency upgrades. So now that you know you can use it, what can you use it on? Well, basically we say any upgrade where either the energy or water consumption can be reduced, and if it can be reduced, the reduction can be measured, either monitored or calculated, but there has to be an energy savings to qualify. And this could be heating, cooling systems, lighting, water conservation, anywhere from capturing water off your roof and repurposing it, or low flow flush toilets, control systems, which are a huge thing that's coming about these days, whether it's lighting controls, building management controls from heating and cooling, or air makeup systems. Also with PACE, because you get access to long-term funding, projects like combined heat and power are now feasible. Huge capital outlay, but you have the ability of, one, producing power at hopefully a lower cost, But more importantly, with combined heat and power systems, you now have a heat source. And if your process building or whatever can use that heat, it is now actually a good investment with PACE. Another improvement that we see huge returns on are compressed air systems. We are quite surprised by the age of the compressed air systems that we see there out in industry. Another use is actually the manufacturing equipment, so process equipment. Again, they are energy users. Some of them use water. If there's a way to purchase new equipment and show that the energy and maintenance and end-of-life replacement is going to offset that expense, that PACE assessment, then it qualifies. However, I think I mentioned this before, PACE improvements are actually considered real property. So when you do an upgrade to a piece of manufacturing equipment, that manufacturing equipment becomes part of the property for the term. And if you enter into a PACE agreement for 20 years and in 10 years you decide to sell, your options are to either buy out that asset, so basically take it off the special property tax assessment, or if the new building that you're moving into happens to be in another PACE district, quite possibly that assessment can then be transferred over to that property and building. So these are a couple of options that have to be considered. A few others: high-speed doors, building envelope improvements from roof to windows to caulking to doors and anything that improves the building. Also renewable energy, wind and solar are definitely feasible. And again, the list of improvements is pretty much very, very long. So how much is available? Well, generally for the industrial, commercial, and multifamily, so we're not going to talk about single-family homes, but these are industrial, commercial, and multifamily, it is going to vary by the lender and the PACE district. Of course, it's all based on risk, and each PACE district and each lender is going to have a different set of rules in regards to the amount that can be financed through the special assessment. But a general rule of thumb is 20 to 30% of the PACE fair market value. And PACE fair market value includes the value of the property, so whether it's an appraised value, appraisal has to be done within the last year or so, a broker opinion of valuation, so basically getting a valuation set for the building, or your property tax state equalized value, so whatever the local taxing authority thinks that the building and property is worth. So you take that, and you can also include the value of the upgrades that will be implemented through the PACE financing. And the reason for that, again, it's considered real property. So a certain percentage of that amount can then be added onto the overall value of the property. And there's a range, 20 to 30%. Now, if you're working towards a 30%, well, you can't have mortgage, you can't have contingencies against the property, it can't be used for collateral. If you have those, then it's discounted, and typically it runs towards the 20% mark. And as we stated, it's going to vary by the lender and the PACE district. So these are things that you're wanting to know up front, and that information is available. So why PACE? Well, as we wrap things up here today, we want to talk about what we believe are some of the top 10 benefits of PACE for those that need to improve the energy efficiency of their buildings. The first one that we want to talk about is 100% project financing. So typically, if you're going to a traditional lending source, they want a 80-20, 70-30 split. This is not the case with PACE. It pays 100% of the project cost, and that would be also any costs that are incurred before the funding comes in. So if there's architectural drawings to be put together, maybe some engineering studies, appraisals to be done, all those costs can be included in the project, and then they are paid for through the funding. So 100% is covered by PACE. Material, labor, everything. The second one, long-term financing, and this is really the mechanism that makes this program work. It allows you to access capital for a very long period of time, 20, 25, 30 years. We've all been talking about it. Boy, it'd be nice if I could get money for a long period of time. I could make this work. It's available. The only restriction you have is it has to be used for energy efficiency, water conservation, or renewable energy projects. And with this, as I pointed out with combined heat and power, it allows the building owners to look at far more efficient solutions that have typically been not looked at because they are capital intensive. And this would include solar, wind, combined heat and power, geothermal, a lot of the large capital improvements that really never ever get considered. The third one, cash flow positive. Now, we're not talking about in year 15. We're talking about it in year 1. And again, I go back to this long-term financing. You're improving your energy efficiency, you're reducing your maintenance cost, and you're reducing your end-of-life replacement cost because a lot of these technologies last so much longer, which puts you in a much better cash position right from day one. And I addressed this earlier, but basically you're paying for it today. You pay for it through your utilities. You're going to implement something that's going to reduce that utility. You're going to take that savings, use a portion of it to pay for PACE, and then the rest of it is going into your pocket. It's going back into the operation. So you can achieve cash flow positive from day one. So we're eliminating the hurdles. You're getting a positive ROI from day one, and you have access to capital. The fourth one is it remains with the property. So I will reiterate, this is not a debt that the company is taking on or the building owner is taking on. It is an expense. So what this allows you to do is in your decisions about the future, if 5 years or 10 years into a PACE assessment you decide to move or sell, that principal amount stays with the property. The property owner is not on the hook to pay for it. They just have to pay for the annual special assessment tax payments. And then when it's sold, that tax assessment is then picked up by the next property owner. So it transfers with the property upon sale. The fifth one is that it's non-recourse. And again, we talked about this already, but the property itself is used to secure the financing, not the owner. So there's no personal guarantee with this. It's not showing up as debt, isn't it? It's an expense, so it doesn't affect the owner's credit. It doesn't affect their borrowing power. And so it's non-recourse because it's transferring with the property. Okay? It can be treated as a off-balance sheet transaction. And when we talk about that, we're focusing primarily on the long-term debt side of things. Because it's not considered debt. It is an expense. It's a property tax that you're paying to improve your building. Then on the balance sheet, that's how it's treated. It shows up as just an expense. And so it allows a company to, preserve their credit, preserve their borrowing power, but yet get access to capital to improve their buildings and operations. The seventh one to mention here is it solves the split incentive issue. What does that mean? Well, this shows up in buildings that are being leased or rented. And in a perfect scenario, triple net lease is probably the greatest advantage, where the building owner utilizes PACE to improve the building, but then all the costs are paid for by the tenants. So, the tenant gets a better building, they get a reduction in energy, and then the building owner also benefits because he's getting a much better building and able to possibly sell it for more in the future. So, in this case, if you're in a building that you're leasing, PACE is still an option, but it has to be approved by the building owner. And if there are some instances where, say, the tenant is sharing in that cost, well, then the operating agreement just needs to be updated to show that sharing. Item 8, low risk to investors. Why is that? Look, they are being, or not they, but the financing is being secured by the building, not by a personal guarantee or the credit of the building owner. And if the building owner defaults and it goes into foreclosure, eventually that money will be paid, because what's the first thing that's paid upon sale? Property taxes and anything that has to do with property taxes, including special assessments. So for them, it's very secure. Building owners are then able to sell without being concerned with paying off that large principal amount that's due on the special assessment. And again, because it's secured by the building, the funders have that security to eliminate or mitigate the risk that they would typically have. Item 9, for those that do have some access to capital to invest in their own buildings and are looking to get a decent rate of return, there are states that allow self-funding, and then you can establish the interest rate at which you want to, charge yourself for the use of the money, as long as it is cash flow positive, meaning you're not going to go in and charge 25% interest and not be able to achieve what PACE was ultimately set up to do: take the savings and pay for the investment. And then finally, the 10th item to be mentioned here is it increases the property marketability. So what does that mean? Let's give a couple examples. If you have a building that is, truly inefficient, you have two choices. You can sell it as is and hopefully do a break even, or find a buyer that's interested in your old building. Or before you sell it, you can go out, secure PACE, improve your building without taking any capital out of your pocket, and then be able to sell it for more. And then upon sale, you're not incurring this payoff of the PACE principal, because what? It transfers with the property. This also works for those that are developers and, buying and selling properties, same type of example. If you're out there looking to buy properties, you want to buy a property that's not in good shape, underperforming. Utilize PACE to improve it. You're not using your own capital, so you're conserving your capital. You have a building that's been improved. So either A, you're going to be able to charge more to the tenants because you have a better building, or B, you're going to be able to sell it for more because now you have a better building to sell. So those are some of the top 10 reasons why we think PACE is a valuable tool for improving our aging buildings and for reducing the amount of energy and water that's being used today. Now, one of the things that we want to talk about is, how is this working? And we're going to talk about a project that is based in Michigan. It's actually the first PACE project in the state of Michigan, and it is a landmark project. And why is that? Well, Michigan's Energy Commission and the Michigan Public Service Commission, better known as the MPSC, actually used PACE, or should I say, the building owner used PACE to improve the building that they were moving into and will be leasing space, or already are leasing space. Now, a little history here. This building is actually owned by someone out of Texas, and the state is the tenant, and it's a triple net lease. So the building owner, again, who's in Texas, was able to use PACE, improve the building without any capital outlay, and then because of the structure of the lease agreement with the tenant, in this case, basically the state of Michigan as a tenant is basically paying for those upgrades through the energy efficiency improvement. So it's a win-win for both entities, as we spoke of before. Not only the tenant, but also the building owner. So this project was funded through PACE. As I stated, it's set up as a triple net lease. The project cost was about $500,000. They secured a 20-year term, fixed rate, PACE special assessment. And the expected energy savings is over $800,000. Now, this is a point that I want everybody to keep in mind. The expected energy savings is over $800,000. And they did quite a few improvements. Implemented some solar, upgraded lighting on both the interior and exterior of the building, some building envelope improvements, and then a large expense was the improvements to the HVAC systems and controls. Now, this $800,000 that I told everyone to remember, why was this important? Because this is the taxpayer dollar. So this is the state of Michigan. This is the agency for energy that's in this facility. So they're the ones that are encouraging everyone to, save energy. And they're putting it into practice, and they're reducing the amount of money that the taxpayers are paying to operate this building. So from a lease standpoint. So it's very, very significant. And again, this is a landmark project because it was the first agency for energy in the U.S. to use PACE as a tool to improve their energy efficiency. And that's very, very important for everyone to understand that it does work, and this is a prime example of how it works. So before we wrap up, a couple of things to point out. Remember, there will be some special reports that are accessible, downloaded, and you should have access to them now. And remember, we encourage you to download them before you leave the webcast, because once the webcast ends, they will no longer be available. And you should find the download feature on the right hand panel, so the lower right hand panel. And also, there will be additional information provided to you on PACE and upcoming webcasts that will cover other topics related to PACE. So be sure to watch for those emails, and we encourage you to attend those webcasts in the future that, again, will talk about different aspects of the PACE program. Well, as stated, we're going to take a couple of questions before we wrap things up here. And again, we won't be able to answer everybody's questions, but we will answer them after the webcast. We will have staff that will answer them. So the first question we have here is from Steve, and it reads, can PACE help to finance building modifications that are necessary to install efficient energy hardware? For example, what if I needed to demo and re-pour a concrete floor in order to install radiant heating lines that are part of a geothermal heat pump system? Great question, Steve. And the answer is yes. In any case, if you have to physically, change the building to adopt something, those costs can be included in the financing as long as it's cash flow positive. Here's another question from Matt. I understand that PACE can be utilized to finance upgrades to a facility's energy system, but can it, and more specifically, how can it be utilized to finance the purchase of more efficient manufacturing process equipment? Another great question, and we touched on this in the webcast. As long as there is an energy reduction or possibly a water conservation with this purchase, and it can be shown that it's going to be cash flow positive over the term, it will qualify. What we do need to point out is that it is considered real property. It stays with the land, and if you're going to sell or move out of the building before that assessment is over, that piece of equipment needs to be purchased outright and then can be moved, or that special assessment would have to be transferred to the next building as long as it's in a PACE district. All right, we're going to take one more question. This is from Melissa. What happens for whatever reason the building owner can no longer pay his taxes, including the PACE special assessment? Are his personal assets at risk? The answer is no. Again, this is a tax. It's not a debt. It's non-recourse. If you don't pay your property taxes, property goes into foreclosure, and it is then held by the local taxing authority. And once it's sold, what's the first thing that's paid for? Back taxes. So it's the same exact structure. The principal amount is not required to be paid for. It's just the back payments that have to be paid when the property is resold. All right, so again, before we wrap up here, want to make sure everybody takes advantage of downloading the reference material that Carrie mentioned. I think you will find them very, very useful. And I also want to thank everyone for attending today's webcast, and we look forward to having you attend our next one. And if you want to contact us for further information, here's the information that you can do so. Gives you our phone number, a email address, and then we also encourage you to just visit our website. There's multiple ways that you can connect with us there, and we encourage you to do so. Again, Thanks everyone for attending, and we hope that you found this webcast valuable.